Stamp duty land tax is a tax that you pay when purchasing an investment property. Now, as property investors, we actually pay a higher rate of tax than first-time buyers and home movers. And the tax rises in line with property values, meaning that the more expensive the property, the more tax you have to pay. But here's the trick. Since 1986, there is one tax that hasn't changed, and savvy property investors are taking advantage of this. If you're new to my channel, hi, I'm Jonathan. I started SPV Mortgages, which is a specialist finance brokerage, about 6 years ago. And over that period of time, we've helped hundreds of property investors start and build successful property portfolios. Now, my channel is all about sharing the experiences that I have with them, with you. Let's start with the background. In 1974, the cost of purchasing shares of a limited company was 2%. It then dropped to 1% in 1984 and has stood at 0.5% since 1986. So that's nearly 40 years the government hasn't changed this particular tax. And that's important for two reasons. The UK government has had no intention of making purchasing shares of companies, either privately or on the stock market, unattractive for decades. And probably the main reason for this is, one, housing is more domestic than it is internationally. Two, the UK government wants to remain competitive in regards to mergers and acquisitions and obviously make it attractive for investors to invest in the stock market. And probably the third reason is it's much easier to increase stamp duty land tax than it is to increase stamp duty on the cost of shares. The majority of property investment purchases are being made via SPV limited companies. Now, the percentage is really difficult to obtain. I have meetings every week with specialist lenders. They're confirming to me that the majority of the business that they're transacting is purchase-based, and it's all through SPV limited companies. Now, some have confirmed that it's around 50%, others have confirmed it's around 100%. So it's really, really difficult to obtain the actual percentage, but what I can say is that the trend for property investment is now taking shape via limited companies rather than purchasing properties in your personal name. So what this means is when you purchase a property in a limited company or an SPV, you're paying stamp duty land tax. Now, if you're looking to purchase a property that's already in an SPV, perhaps using a different SPV or in your personal name, you'll have to pay the stamp duty again because there is a change of ownership. But if you purchase the shares of an SPV that's already purchased a property asset, that stamp duty land tax has already been paid. So the owner of the property, that being the SPV, isn't changing. All that's changing is the shareholders and directors of the SPV, of the company. So in that case, you don't pay stamp duty land tax, you pay stamp duty on the cost of shares, which is currently 0.5%. There are currently 3 ways to purchase shares of an SPV, and I'm going to order them based on cost, highest being first. Bridging finance. So this is probably the most common way of purchasing shares in an SPV. You would use bridging finance to purchase the SPV that then owns obviously the property assets. We then refinance the SPV onto an SPV buy-to-let product. Pros and cons? Well, pro, you're only paying 0.5% on the stamp duty. The con is bridging finance is one of the most expensive products available, and there are cheaper ways now to do this type of transaction. So the second is share purchase. Now, this is brand new to the market. There's only one lender that's doing it currently. It's going to be written into policy. They're just trialing it at this moment in time. It works exactly the same way as bridging finance, where you purchase the shares of an SPV that already owns property assets. But instead of being charged bridging finance rates, you move straight on to what's known as a term product. So in other words, an SPV buy-to-let, which could be fixed or variable 2 or 5 years with a term of say 30. So the third is a refinance. So this is where the directors and shareholders change, but are not fully removed. So if I own an SPV 100% and I am the sole director, you could make an offer to purchase 90% of the shares and become the sole director, therefore remaining, for me, 10%. The lender will treat that as a refinance. So in other words, they will refinance the property assets within the SPV, release the equity, which is then paid to me, the original owner. I sit at 10%, you then have 90% and are the sole director of the company. We then set up an agreement to purchase the remaining shares at a specific amount on a specific date. That date being when the original lender is repaid in full. So there's 2 transactions here. One transaction to reduce the shares of the original owner and add yourselves, and then the second transaction to completely remove the original owner of the SPV. This is the most technical way of structuring the SPV, but also it's the cheapest way of purchasing shares in an SPV as it stands today. So the typical requirements for obtaining an SPV share purchase product or bridging finance to purchase the shares within an SPV is you've got to have good credit, but you don't have to have particularly clean credit. Ideally be a UK national, UK resident, but you can be a foreign national as well. You've got to have a good level of income, pay UK tax ideally, and have property assets in the background, although there is a workaround for being a first-time buy-to-let landlord. Now, as long as you meet that very basic criteria, then there are going to be financing options available for you to purchase the shares of existing SPVs. You've just got to take into account that the rental stress test from the property or properties held within the SPV meet the minimum requirement, especially on the SPV buy-to-let lenders, but also it plays a part in the bridging finance as well. And you can purchase one property within an SPV or 100. It makes absolutely no difference. So SPV share transactions, although are uncommon at this moment in time, will become commonplace moving forwards. Now, SPV share purchases are very uncommon currently, but they will become the norm or a standard way to purchase investment properties moving forwards. Now, if you're thinking about investing in property, but you're not too sure about the economy, the housing market, or perhaps future interest rates, watch this.